I'm Osborne Foreman and welcome back to the channel. Today we're going to be talking about why I hate diversification and consequently why I hold only a handful of stocks in my portfolio. And if you like the video, please drop one of these to beat that YouTube algorithm. Firstly, let's talk about my investment strategy. I try to invest in high quality stocks that have strong underlying financial growth and fantastic balance sheets that have very limited debt or good strategic use of their debt and high levels of cash, as well as significant competitive advantages that allows them to build a strong moat, meaning that other competitors in the industry will find it difficult to claw up market share. Typically, these companies, if in earlier stages, can be very disruptive to the industries as well. I have a highly concentrated portfolio that I invest in a very small amount of stocks, and these companies are ones that I can easily understand aside from one, although that's not relevant in this video. And this is primarily because I'm young. I'm on a low income at the moment because obviously I've got a long way to go in terms of my career path. At the moment I'm making at best around £13,000 per year, and this means I have very small amounts that I'm able to contribute and invest into the markets. You may wonder how I have a portfolio of my size, and that's because I'm able to save a majority of my income, and we're looking at around 80 to 90% of my income I can save and invest just to having limited reoccurring bills and living with my parents, which obviously means that I have limited things to spend money on. But this means that a diversified portfolio with my low level of wealth means that I'm not going to get very strong returns. In fact, it wouldn't be beneficial for myself to diversify. And this means because I've got a low income that multiple diversified positions will only drag the average annual returns downwards and more in line with the markets. I'm also more likely to include more bad stock suggestions in my portfolio if I expand out further. This means that I have more limited research on each of these individual companies, and as I hold more than 10, 15 companies, it becomes very time consuming to be able to keep up with all of them, especially because I'm still very much in the early stages of my investing process and I've still got a lot to learn. This means that I'm not as efficient as I would be at researching the companies and keeping up with to-date news. I would say a diversified portfolio is a very good defensive strategy. A defensive strategy would be more applicable when you're looking to preserve your wealth. If you had 7, 8, 9 digits of wealth and you're looking to preserve your wealth but also bring an income from it, then you would not have a similar investment strategy to myself. And I think it's very important in the stock markets that you tailor your investment strategy to your own personal situation. And with your own personal situation, if you're able to identify what common factors there are, you may be able to do better than the overall markets. Although I'm not speaking from experience because I am currently underperforming them. If I didn't have a concept of what qualities to look for in my stock picks, then perhaps diversification would be a great idea or concept for myself, because diversification is protection against ignorance. And after all, if you don't want to understand or don't understand the markets, then it makes a lot of sense to dip your fingers in every pie so that you are well adequately protected in the off chance that there's an industry-wide drop. That way you would have a limited exposure to it and the other industries will be doing, well, as usual. But this also means it limits the upside potential as well, because if you've got your fingers in all these pies and then one of your industries that you are bullish on does well but you only have a limited exposure of around 5%, that whole industry could double in valuation and that would only be equivalent to 5% returns in your portfolio. That's really not much. Whereas if you held 5 stocks like I do myself, each of these, even if they were equal positions, which they are not in my case, this would mean that if they doubled, that could be equal to 20% returns, which is a considerably different amount. And so I feel that it's at my stage of low wealth, it's more valid to invest larger amounts in a concentrated portfolio so that I can benefit from their potential upside. And say, for instance, I start to lose money. My stock positions are down. I'm very young. I'm 21 years old. I can wait many years for these stocks to recover. And I can also take advantage of the dips. As I said, I have a low level of wealth. These dips now, whilst I have this limited wealth, aren't going to be life-changing to me. But if I had 7 or 8 figures a portfolio, these dips could certainly change the game massively. However, whilst I'm very ignorant to what I may know in the longer term of my investment experience, I feel that it's all a learning experience, and the best way to truly learn from the markets isn't from passively copying the markets and investing in index funds. It's instead investing on your own accord and learning from your mistakes. Right now, I may be underperforming. I may have made a lot of mistakes, but I hope that these are strategic financial mistakes that come at a small cost to the portfolio, so that over the longer term, my growth may increase because I've made these mistakes before, can spot the common trends, and then benefit over that longer term period. In fact, I can afford to make these mistakes, as I mentioned, because my portfolio is a very small size. If it was much higher and you were, for instance, investing £1 million into the markets, then 40% of your portfolio dropping like by half is going to severely dent your overall value. Whereas with the likes of a small portfolio, it really doesn't matter as much, and you'll likely be able to deposit that money back into the markets with your annual income over time. It's important to note that I've never claimed to be the best investor in the world, nor have I claimed to be a good investor for that matter. Furthermore, I've never claimed to be a financial professional. I still don't understand why people assume that. I look to learn as much from others as possible, hence why I created the YouTube channel, to document my own experiences, so that if someone else wanted to learn as much as they can about the stock markets, they can look at my journey in the markets, all of the steps I've done in my first few years, and perhaps learn from those key mistakes so that they themselves don't make those mistakes and do better. Therefore, I plan to jump head first into the markets, make as much mistakes as I can, not on purpose of course, but the mistakes I do make that I can personally learn from and benefit in that longer term future, where I can spot the common trends and avoid it. There is a good argument to index funds. Index funds are much more passive, you don't have to spend the time on it, and you can effectively reduce stress knowing that you're invested in the whole world. However, this is something that I don't like. I don't want to get average annual returns of roughly 8% over the 30-year period, for instance. I'm more interested in outperforming that. And if I'm invested in index funds, my chances of outperforming the markets are nil, because they are the markets and they're going to have fees on top, meaning you're always going to be underperforming. I don't want to settle for average. I want to outperform. And so I will actively try to do my best to outperform these. I also feel that there are lots of low quality stocks that these index funds are invested in. For instance, if you have a UK portion of inside your index fund that is invested in UK equities, you may find that they are heavily dominated by those in the FTSE 100. I strongly feel that a lot of those companies in the FTSE 100 are weak. They're bad, old world businesses that are really not doing too well. Sure, they're generating a lot of cash, but financially they're not going to grow by that large of an amount. And so I would feel that I could cut out the low quality businesses with high levels of debt. I can start to slim down the active pool until I've got a very small sum of companies that I can look to invest in. And I can cut out all these low quality companies that don't align with my long-term visions of the future. And if you're interested in signing up to my stockbroker Freetrade, you can get a free share worth up to £200 or a minimum of £10 if you sign up before June 30th. So click my link in the description down below and sign up to Freetrade. I very much believe that the UK markets are under-researched, undervalued and overlooked. A lot of people in the UK that invest in stocks are immediately jumping to the more attractive US markets, and it's understandable because they dominate a large majority of the global stock market operations. In fact, according to Alta Fox Capital's research on the makings of a multi-bagger, the US represents 44% of the stock universe. However, when looking at the total shareholder returns of investments of above 350%, they were in fact underrepresented. From that 44% that they took up of the stock universe, they only represented 29%, meaning that it's going to be more difficult to find companies that generate high shareholder returns in the US because there's such a larger pool of them, and in fact a lot less of them make it through in their personal set that Alta Fox had provided. Whereas on the contrary, the UK and a select few other countries were massively overrepresented. This is because the UK represents 10% of the global stock universe, according to Alta Fox, and in their stock set, or the findings that they had found, they had discovered that the UK represented 15% of their set. This is impressive. The UK being overrepresented means they're making or they're providing much more multi-baggers returns of 100% or more, in this case more than 350%, than the likes of the US in ratio. Whilst sure, the US is still providing nearly double the amount the UK is, the UK is very much a small fish in the universe, or the global universe stock markets. In fact, 13.46% of these top performing stocks are from the AIM listed markets on the London Stock Exchange. This is huge, and this means, in my opinion, that I should be focusing a lot more attention into these markets. This is something that I have the advantage on because I'm a UK citizen. For a lot of these companies, they are UK domestically based. If I were a US institution or citizen looking to invest in the UK, I would be immediately at a disadvantage because I wouldn't know what small businesses are around. But because I live here, I feel that I have the advantage investing in the UK. And this brings me on to diversification. Why would I look for diversification into the US markets when I can identify these small businesses in the UK that have a lot of potential for the future? And in that way, I'm not going to follow the hype with US stocks. Sure, there are a lot of fantastic names in the US markets that are high growth and they are really dominating in the field, disruptive businesses with massive amounts of free cash flow and earnings growth. But these aren't what I'm interested in. I'm interested in very strong companies, but in markets where they perhaps aren't valued as high as they could be. And this is exactly why I hold 5 UK stocks, and I'm likely going to slim this down even further. I feel that I have the advantage against these institutions when looking into smaller cap UK stocks. These smaller cap UK stocks are already going to be less known. The likes of US, once the retail investors find a stock, that gets pumped massively. A similar trend would happen here, but on a smaller scale. I feel that if I can beat the institutions to these investments, build up substantial positions, then I could do very well over the longer term, and such diversification does not feel like a good idea to me. So that I can have a small concentrated portfolio of high quality stocks that I strongly believe will dominate over the longer term. This means I also spend less time trying to follow all of these stocks, because if I hold 4 or 5 companies, then I individually will be able to keep up to date with them much easier. That's less stress for myself, but also represents high exposure should they do very well in the future. It's effectively a very high bet on these companies that they will do well over the next 5-10 years. However, as I've mentioned before, if I had much more wealth, then I would look to preserve it. I would diversify my investments further. I may hold 10 to 15 stocks, and at that point, I think that would be a more sensible amount. I would set limits for the upper sizes of positions as to not ruin my portfolio and overall size if it was much larger. This is the early stage of my investment horizon. I'm 21 years old and I can invest for many more years, and so it seems illogical to me to decide to diversify. That, combined with little to no recurring or regular expenses, means that I can save a lot of that income, and this means that I will not need this money that's invested for a very long time period, allowing for myself to stomach more volatility, take on more risk, and hopefully increase the risk to reward ratio. That means I can do very well over the longer term period. At least for myself, it seems pointless to diversify, but we all individually have different opinions on this. Some of us are more risk averse, and some of us have much more wealth invested, and it would make a lot more sense. I have a lot of free time because I'm young. This means I'm going to spend this time investing and researching stocks so that when I have less time in the future, I may be more well prepared. And I can use the money that I have now as an investment in my own self, not just in my financial instruments, but rather in my own mind. If I'm investing in myself, I can develop my head, become stronger and more dominant in investing in the markets, and benefit over that longer term period, as I'm consistently mentioning, which then I can specialize and into a few specific industries and really enhance my knowledge and know exactly what qualities to look for perhaps in a fast fashion retailer, or what qualities that, or what type of a moat a company that is in the games development or software development industry should have. If you're interested in my free UK stocks to buy in June 2021, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.